Welcome, everyone. I'm Mary Brown Sands, Head of Marketing and Communications for the Small Business Investor Alliance, the leading association for small private equity and credit funds and investors. SBIA works on behalf of its members as an advocate for public policies that promote competitive markets and robust domestic investment for growing small businesses. SBIA not only delivers a valuable policy voice in Washington for our members, it also offers connection to an exclusive program of partner-level networking, deal sourcing, and market update opportunities through highly curated regional events and private equity conferences, critical policy and regulatory updates, access for general partners and limited partners to fundraising, deal-making, and investing that's focused on small business investors, and access to the policymakers whose decisions impact how you manage your fund and your investing strategies. SBIA is pleased to continue our 2024 Lunch and Learn webinar series with today's session on Mastering the Leveraged Draw Process, Operational Best Practices, where experienced professionals from CSC will take us through a primer on the leveraged draw process for SBIC funds. Whether you're new to the leverage process or just want a refresher, this session will provide step-by-step guidance to give you the practical knowledge you need. Before we get started, I'll mention a few housekeeping items. In your Zoom menu bar at the bottom of your screen, please find the Q&A feature. If you have questions during the webinar, please submit them here. Also, please use this feature to let us know if you're having any technical issues. Today's technical director, Taylor Thornton, will reply with suggestions. Please note that this session is off the record. Comments, statements, and materials are not to be published or recorded without approval by SBIA and the professionals at CSC. Since 2020, SBIA has produced 28 educational webinars, providing valuable content for our members and industry colleagues. However, we could not provide these high-level and cost-free opportunities without the collaboration of our exceptional sponsors. Today's session is made possible by the support of longtime SBIA sponsor, CSC. CSC is a leading global provider of fund administration and compliance solutions. With over 20 years of experience serving SBIC funds, an industry-leading technology platform, and a high-touch service approach, CSC empowers firms to confidently meet complex reporting requirements. It's my pleasure today to welcome Delphine Jones, David Garcia, and John Foster from CSC to lead today's discussion. Delphine is the Managing Director of Fund Solutions at CSC. She is a CPA with over 25 years of experience working on registered and private funds, with a focus on SBICs for the past 10 years. David is a Director of Client Solutions for CSC. He is a CPA with over 25 years of experience working on registered and private funds, and he has focused on SBICs for the last 7 years. Also a CPA and a Director of Client Solutions for CSC, John has over 30 years of experience working on registered and private funds, and he has focused on SBICs for the last 2 years. Delphine, it's my pleasure to turn the program over to you to get us started.
Thank you so much. And good afternoon, everyone, and welcome to this afternoon's webinar, where we're going to focus on mastering the leverage draw process. What we're going to discuss this afternoon is going to be focused on an overview of the leverage draw process. Then we're going to go into what we consider to be the starting point for the process, which is the commitment application. Then we'll speak to the leverage draw. And last but not least, we'll discuss how leverage is repaid. At the very end of the webinar, we'll open up some time for questions and answers. With that, why don't we jump right into the program? And John, why don't you please walk us through an overview of the leverage draw process?
Thank you, Delphine. With the SBA, there's usually one more step in the process than you think there's going to be. So step one is in getting licensed and receiving a licensing letter, which will tell you the maximum amount of leverage that you will eventually be able to take. This is not, however, a commitment by the SBA to loan you that amount of money. For that, you need to go to step two. So step two is formally requesting a commitment from the SBA by submitting a commitment request package. The SBA will respond with a letter telling you how much they will commit to lending to the SBIC over the next 4+ years. Now, getting this letter is great, but it still isn't enough for the SBA to start providing leverage proceeds. Step three is that the SBIC now must request approval for a specific dollar amount that it will be drawing from the SBA. There is a leverage draw package, which is completely separate from the commitment package, that has to be prepared and submitted. The SBA will then respond with a letter telling you what has been approved for you to draw down. Now you finally get to step 4. And step 4 is submitting a request to actually get the cash dispersed to you. So today we'll focus on steps 2, 3, and 4. That is, after getting a license, what's involved with requesting a commitment and what is involved with a leverage draw package, and then how do you actually get the cash disbursement. And at the end, we'll also talk about considerations when it comes time to pay back the debentures.
Thank you, John. And one of the things I also wanted to mention was that the discussion today is going to be focused on the traditional debenture program and not on the accrual or the reinvestor program. So think debenture. All right, David, why don't you walk us through the start of the process with the commitment process?
Thanks, Delphine. So now you're at the commitment process. You're starting to prepare the commitment package. In the commitment package, one of the initial requests is how much of a commitment you're going to request. I'm going to get into regulatory capital, but I'll discuss that later on this presentation. Let's say you're requesting one times your regulatory capital, which if it's a $50 million fund, it's $50 million initially on the commitment package. With this, you have, in addition to that, the attachments are 13 to 14 different types of certifications. For example, do you have any material adverse change to the financial condition of the license since the filing? Have you filed the most recent capital certificate and you're saying you're attesting that it's accurate, and so forth. Now, not every certification might be applicable to when you're applying for the commitment package. So I've seen alterations to the certifications. In addition to that, you have other forms that you're filling out here, like Form 25, Form 652, that's also attached to the commitment package. In addition to that, you have to provide debit authorization and bank identification. For the bank identification, what this allows them to have is in bank information when you're ready to draw down into the debentures, the proceeds of those debentures come into the bank account when you have to pay interest, of which is semi-annually, and they could do an ACH off your bank account. And like I said earlier, the capital certificate is also one of these attachments, but you have to attach it to the SBIC web, not necessarily in the package. The last 2 bullet points are no longer applicable since there were changes to the standard operating procedures in August of 2023.
And one other thing I wanted to mention is that you're going to get your initial license, and in your license letter, your license approval letter, the SBA will tell you what their intended leverage commitment amount is. That is an amount based on your application with the SBA. So based on that information, they will tell you that you're going to get up to maybe 2 times your regulatory capital with a maximum of 175 million. And that they will finalize that amount when you do your last close, your final close 12 months down the road. But that is the start also of this process, is having the SBA tell you what the intended total commitment amount is. And as David mentioned, then you actually have to submit your commitment package.
Okay.
When time is there any other expirations that we have to keep in mind?
Sorry. When you request a commitment, there's a 1% upfront commitment fee, and it's important that you understand what that means for the SBIC's cash flow. After submitting a commitment request package to the SBA will respond with a commitment letter telling you the amount of the commitment, and also telling you that you have 30 days to pay the SBA 1% of that commitment amount. This 1% has to be paid before you can move on to the next step and request a leverage draw amount. So managers want to take this into account when deciding how much commitment to ask for. For example, if you ask for a $50 million commitment, that means that the fund has to pay $500,000 out of its bank account before it can borrow from the SBA. If the fund doesn't have $500,000 sitting idle, then the fund needs to do a capital call just for that purpose. So because of this, managers don't necessarily rush into requesting as high a commitment amount as they can up front. You can submit up to 2 commitment requests in a calendar year. So some managers prefer to request the commitments in smaller but more frequent amounts. The commitments themselves will expire on the first September 30th, occurring 4 years after the commitment is approved. So that means that the commitment is always good for at least 4 years, but less than 5 years, depending on how long before September 30th you applied for it and got the commitment.
And the SBA is very timely in sending out the notices to you to let you know your commitment amount. That notice would also give you information about the expiration of the commitment. It will tell you how much the commitment fees are. So we'll get something from the SBA that spells this all out for you. David, why don't we now turn to the actual leverage draw process and talk about leverage draw timing.
Correct. Now you're at the leverage draw stage. You've got a commitment package. You've got an approval for a commitment package. Now you're ready to draw down some leverage. Leverage can be drawn down at pretty much at any time, but for the SBA, they accept them the first and third Wednesday of every month. The cutoff is at 10:30 in the morning on a Wednesday. The dates might change, so consult the SBA calendar for changes, for holidays and whatnot. The SBA, once they receive your leverage draw request, they usually approve it within the following week, which is the following Wednesday. The approval notices, now you have approval notices, the notices are valid for only 58 days. Now keep in mind, if they expire, there are no penalties or extra charges from the SBA for unused and expired approval notices.
John, so what are the next steps that we have to go through as far as the application for drawing down leverage?
So the leverage draw application process has a few components. There are a few things that need to be put into the leverage draw package. The first is the leverage security instruments. This is Form 444C, and it's essentially a standard template of the borrowing agreement. Next, there'll be a statement saying that there's been no material change in the fund since the last Form 468 was filed. If the SBIC is newly licensed and it is rushing to draw down leverage as quickly as it can, the SBIC might even need to file an interim 468 before the leverage draw. There'll be a statement of compliance, which basically says that the SBIC has been and is complying with all of the SBA's rules and regulations. Then there's a statement of need. This is the most involved part, and we'll talk about that in more detail in just a minute. There's an opinion of counsel from the SBIC's law firm and a certification that at least 25% of the SBIC's investments will be in what the SBA defines as smaller enterprises. An up-to-date capital certificate won't necessarily be filed with the leverage draw, but needs to be on file with the SBA, supporting the amount of the leverage draw that you're requesting. And David will talk about that in a few minutes. As part of the request package, you also have to detail the amount being requested in the debenture funding request. And it's usually broken out into 5 different debentures. So, for instance, if you want to be able to draw down $10 million, you would submit a leverage package which states that you want to get 5 different debentures, each giving you $2 million of leverage. Now, you don't have to break your borrowing amount into 5 pieces, but managers almost always request it this way in order to provide maximum flexibility in the future when it comes time to repaying them. And David will talk more about repayments later on. And the debentures, the requests have to be in increments of $5,000. When we go to the next slide and the statement of need. Okay. The statement of need, it's part of the leverage draw application, and it can take a while to prepare. Before the SBA will give you the leverage, the SBA wants to know in very granular detail how much cash you have and how much you're requesting and what specifically are you going to do with that cash. So the statement of need is essentially a cash forecast. The SBA asks you to take the cash balance from your last 468 filing and roll it forward to a relatively current date, say within the last week. Then the SBA wants you to estimate all of your expected cash flows, inflows and outflows for the next roughly 2 months, including the requested borrowing and investment purchases. So this is going to include, again, all of the expected inflows and outflows. What coupon payments are coming in, what expenses are being paid, what securities are you purchasing. If there's a separate line of credit you have in place, what is going on with that as well. So at the end of this 60-day forecast, the SBA wants to see that your expected cash amount 2 months from now is going to be either less than $1 million or less than 1/4's worth of management fees, so that the SBA doesn't see you as over borrowing.
This sounds like a very involved process. So we're basically saying that to get the leverage, you have to submit a commitment application, have that approved. Then you have to request a commitment amount, have that approved, and then you have to go in and specifically request an amount that you want to draw down on. And what you're advising us to do is to basically think about the pipeline that you have to make sure that you're not drawing down too much with this go around, because the SBA requires that you pay a fee. I think you mentioned that maybe it's 1% fee that you have to pay that fee up front, and that could be a drain on the cash flows for the fund. Did I summarize that correctly?
Well, yes, the 1%, that's on the commitment package, and that's the 1% which does not come out of borrowings. That has to get paid up front there. So after the commitment package is the leverage draw package, which David and I have just been talking about there. And that's where, in the leverage draw package, that's where we have to have this statement of need. And that's where, the SBA wants you to have less than $1 million or less than 1/4's worth of management fees at the end of that. So it's kind of 2 different considerations. One consideration with the commitment package, how much of a commitment you want to request. And then separate from that, when you go to submit a leverage package, how much are you going to ask for in that leverage package?
All right, David, then let's flip to the next area, which is talking about the impact of the capital certificate on how much we can draw down in leverage.
So now we talked about the commitment package. You get an approval for a commitment package. Then you have the ability to draw down from that commitment package. But you can't speak for those 2 items without talking about a capital certificate. So the capital certificate kind of ties everything in my head. So what happens here is what is a capital certificate? A capital certificate gets submitted to the SBA for various events. When a fund calls money from its investors, it requires a capital certificate after the money's been received. All of it's been received 30 days thereafter. When you make a distribution and you consider it for SBA purposes, return of capital. When there are transfers, name changes, when there are investor status changes, that affects a capital certificate and they have to be filed. So why do I mention a capital certificate? Because when you draw down leverage, they look towards a capital certificate. What are they looking at specifically? They're looking at leverageable capital and regulatory capital. Leverageable capital. Leverageable capital is cash paid in from your investors, not a receivable that you're going to get in the future, actual cash received and put into the bank. And I say that, and I say that specifically because we should not put any receivable that you have, any cash you have not received in leverageable capital. So when you look at leverageable capital and a fund contributes from its investors, calls $10 million and it's received $10 million, I'm expecting to see leverageable capital of 10. So when you do a drawdown package, a leverage draw request, how much can you draw down? So if you've been approved for 2 times regulatory, let's say you can borrow $20 million because you're 2 tiers. So if it's 10 million leverageable and you've got approved for 2 tiers, you can borrow 2 times leverageable capital. That's a 2-to-1 ratio. And that's important to distinguish from leverageable versus regulatory. Regulatory is, to put it in a simple fashion, is somewhat of the total committed in the fund. There are exceptions to that. There are exceptions when you're not an institutional, when you don't have backing towards your unfunded. The regulatory number might differ from your commitment amount. Okay, so for example, if you're a $50 million fund and total commitments, let's keep it simple. Your regulatory could be 50. You got 2 tiers that you've been approved for leverage. That's $100 million you can most likely borrow, but you're capped at the leverageable. So if your leverageable is $10 million and you're approved for 2 times regulatory, you can only borrow $20 million. If you need more than 20 million, you're going to have to call more money from your investors and then do another leverage draw request.
And David, let's go on to drawdown limitations. You hit on a couple of these points, and maybe we can clarify this a bit for everyone.
Correct. So as an SBIC, some of the greatest benefits is that you have all this ability to borrow this leverage and at a reasonable rate. Typically for an emerging manager, what we have seen is 1 times to 2 times that regulatory capital number. They say 3 times. Historically, I have not seen 3 times of regulatory. As I mentioned earlier in my previous slide, the draw is based on leverageable capital. So if you've been approved for 2 times regulatory capital, which is somewhat, with exceptions, somewhat similar to your committed capital, and your committed is $50 million, and your regulatory ties in perfectly 50 million, and you've been approved for 2 times, that's $100 million. However, if you haven't called 100% of that, you've only called 20% of that, which is $20 million, $10 million, then you can only borrow 2 times that. So it's a trigger. The capital certificate is intertwined to the commitment package and the leverage draw request. Maximum per fund is 175. So if your regulatory is 90 million, let's say, and you've been approved for 2 times regulatory, and your regulatory is 90 million, you're capped at 175. The maximum per fund family, what does that mean? If you have more than one license, let's say you have 2 funds that are licensed, you're capped at 350 per fund family. That's how they consider it.
And David, at what point are we specifying and asking the SBA, for the different tiers of leverage that we can get? Is that something that is included in the application process?
You could start it off you could do it during the application process. You could do it during the commitment process at a later stage. So there's multiple times that you could really work on this.
All right. So again, considering that we're all focused on making sure we can gain access to this leverage, there seems to be a lot of things we have to take into consideration. And based on this slide, the key takeaway here is you really need to focus on how much you have in leverageable capital, because that's going to dictate the ultimate amount of your draw amount. All right, John, let's talk then about the fees that are involved. Everyone's saying that this is a chance to get lower interest borrowing from the government, but are fees and interest involved. So why don't you walk us through the leverage fees, and then we'll go through the interest component.
Sure. The fees that you see on this slide that we're calling leverage fees, the unifying piece on these 4 fees here is that they are one-time charges. So they are deducted one time right from the leverage proceeds. So 2.435%. When you request the cash to be dispersed to your bank account, what will hit your bank account is a net amount, net of this 2.435%. So that is what will hit your bank account. And back on the statement of need, that's one of the items that is on there under inflows and outflows. You might borrow one amount, but you're only going to get the net amount. So that will be reflected there as well. So these are, in general, just the one-time fees. If we go to the next slide, this is what most people think of as the interest component. And the interest component actually has 2 different pieces. The first piece is a minimum annual charge. So these amounts here, these are annual amounts, and they are added in with the regular interest rates. So again, the interest that you pay is going to be 2 pieces: the annual charge plus the interest rate there. So those are combined together, and you'll pay just the one combined interest rate. Actually, you're going to end up paying 2 rates during this time period. From the time that the pooling takes place, from the time when the distribution takes place, when you take the cash proceeds, up until the pooling date, there is one interest rate. But then on those pooling dates, and pooling happens in March and September, at those times, the debentures are pooled together, and there is a new interest rate, which will be in effect for the duration of the debentures for the 10 years, with interest paid semi-annually. And that is the interest.
So, and the long-term rate is going to be the rate that will be applicable until the debentures expire, let's say 10 years down the road, correct?
That is correct, yes. So yes.
Well, David, let's then move on to the next section, which is we borrowed money throughout the course of the the fund's life. And at some points, we're thinking about paying some of this back. So what are some of the things that we need to be cognizant of when we think about repayments and prepayments?
Thanks, Delphine. So what you typically see is you're past your commitment period, your investment period, 5 years down the road. Now, without me getting too much into it, you have some kind of wind down plan, which that's another topic in itself. And now you're ready to start paying down debentures. The debentures, when you repay them, there are two methods of repayment. There is the regular prepayment, and there's the advanced prepayment. The regular prepayment, that is when you're paying during the March 1st or the September 1st cycles. With those are the timelines on when you pay the interest on these debentures. Versus the advanced prepayment when you're paying off during the non-scheduled times. What's the difference? The difference is when you submit a prepayment template to the SBA on a debenture prepayment, you're basically telling them the debentures that you're paying in an Excel schedule and submitting that. An advanced prepayment is you're paying this in advance during non-scheduled times, for example, in January versus March. And on this schedule, you have to give them the list of debentures, the serial numbers, and the interest and the annual charge on these schedules. Now, when do you submit this? You submit this for regular prepayment 5 days in advance of the payment date. For the advanced prepayment is 5 weeks in advance of the next payment date. Okay. Now, when you send them an email that you're making payments, you attach the proper template on the email for it to be approved. Okay. They review the schedule and they'll send a confirmation that the serial numbers, the debentures, are accurate, and they'll send you confirmation with wire instructions to send the money to Bank of New York Mellon.
Hey, David, do I remember right that the debentures, there's no partial payment of them? They can only be paid in full?
That's correct. Debentures have to be paid in full. Typically, what you see in our profession is if you're going to pay debentures, pay the ones with the highest interest rates, right? You want to reduce your costs on your fund. So you pick the ones with the highest interest rates and you prepay those in advance. Now, what I always recommend to clients is when you prepay, try to prepay during the cycles, right? Why do I say that? Because if you prepay a debenture, let's say in December for the March 1st cycle, you have to prepay all the interest through March. So even though you've got the money and you want to prepay the debenture, you're still going to have to pay all that interest. So be mindful when it comes time to prepay. Mm-hmm. And of course, there's no prepayment charge because these are 10-year debentures. But you could pay them at any time. However, just keep in mind when you're making an advanced prepayment that the interest has to be paid in those specific cycles up front.
Well, that's interesting. So no prepayment penalty, but they're going to make you pay the interest as if you took it all the way through to the next standard payment period.
Exactly.
And because the debentures have to be, you cannot partially pay a debenture, they have to be paid in full. That's why we say that you should break them out into as many pieces as possible. My example of $10 million draw, you would want 5 $2 million tranches there, debentures, so that if you only want to repay $4 million, you just pay off 2 of those, $2 million debentures. Whereas if you had one debenture for the full 10 million, you wouldn't be able to partially pay. So having as many debentures as you can gives you the flexibility to plan your cash forecasting.
Right. And I always tell our clients is think of the SBA as the largest investor in your fund. Treat them that way and try to prepay as much as you can and as fast as you possibly can.
All right, so the process is kind of interesting because in order to get money, you have to, again, file a lot of documents. So if you needed to find all of these documents and do more research on your own, what's the best way to do research for commitments, capital certificates, leverage draw packages? What's the source for us to use here?
Well, the SBA.gov has all these forms, all these guides, all these instructions. It's very simple. You could look into the forms and guides on SBA.gov, and they give leverage, commitment instructions, debenture pay down instructions. It's pretty thorough, and you just go step by step. All these forms that I mentioned in the commitment package, they're all there. You could download them. I believe you can actually download them in Word and PDF in some cases.
And just a caveat, there are some documents that are specific depending on when you got your license. And so the SBA has on their website should have a tag on each document to tell you if that document should be used, if you're I'll call it August 2023, or if you're post August 2023, which is the date in which the new regulations were issued. So make sure that when you're looking at the document, you're looking at the one that is specific to the timing of when you got your license. And that way you'll be sure to pull together the right documentation that the SBA is looking for. I would also say that, reach out to your analyst when you have questions on any of this. They are your best source of information. And if you're trying to figure out anything that's maybe a little bit odd, they'll be able to give you guidance as to the best way to proceed. Okay. So David and John, any other tidbits of information or tips that you would like to share with the group before we move on to the Q&A session?
No, I do want to reiterate what you just said. Make the analyst your best friend, because if you can grab their attention, the resource is valuable, and you want to know how they think, right? Because it's going to matter at the later stage of the life of the fund, how you want to distribute money, how you want to pay down these debentures, because you want to have a balance somewhere between the pay down and distributions to your investors.
Mm-hmm. As far as resources, David mentioned SBA.gov. Certainly, the SBIC, will have legal counsel, and law firms, can often help to interpret what you see and find on SBA.gov, as well as a bit self-serving, but an administrator such as CSC. We've also found that the SBIC community, it's not that large, and we have seen a lot of our SBIC clients interacting with each other directly, and there seems to be a kind of a healthy forum of information sharing by investment managers who are running SBICs.
I do remember that there's a CFO type of group that's is specific for SBIC. So if there are any CFOs on the call, you might want to look into being part of that group, because as John mentioned, they're a wealth of information and they're willing to share. It is a small community, and the more we all know, the better we'll all be, and making sure that we can operate the funds efficiently. All right. with that, we can move into the official Q&A session. If you have any questions that you would like us to address, if you can share those with us, we'll try to get through those. If we can't get through your question during the remaining time that we have, you can send your questions directly to me, and the address will be posted as delphine.jones@cscglobal.com, and I'll be able to coordinate answers for you. Some questions. So if an SBIC opts to reduce regulatory capital by org cost excess, does that also reduce leverageable capital? Okay. So
I'm sorry, read that
what I
again,
see
Delphine.
is that org cost, the excess org cost reduces management fees. It doesn't necessarily, so the fee that's being paid to the manager, it should not be reducing your regulatory or leverageable capital.
Yeah, agreed.
Second question. Standard debentures. Okay, so there's a question asking if we can outline or highlight the major differences between the standard debenture program and the accrual debenture program, if any. I can take that one. What we're seeing in general is that the differences between the two is that the accrual program is going to max you out at 1.25 leverage as opposed to up to 2 times leverage. And that leverage is going to be calculated the interest on the leverage is going to be calculated over the life of the debentures, but you are not paying current interest. So you're not paying interest semi-annually. That is going to be added to the principal, if you will, so that all of that will be paid at maturity date. However, when you're looking at the total amount of leverage that's available to you, they're going to be looking at both the principal and the interest that's outstanding to determine where you are within that max. Whereas with the standard debenture program, interest is not a component of the total amount.
So Delphine, what you're saying is if you can borrow $50 million, right? That's your cap of 1.25 times. You've got to factor all the interest. So you really can't borrow 50 million. You got to borrow something, I don't know, 30 plus, right? I'm not doing the math correctly, but it's got to be a lot less than the 50.
It has to be less because because the interest on that is going to be
it's back, right?
Part of that 50. So the principal has to be, as you put it, much less than the 50.
Mm-hmm.
Just one clarification there, Delphine. With the accrual debentures, it's true there are not periodic interest payments. However, as the fund makes distributions back to the LPs, the SBA will expect that a certain portion of the debentures and the related interest be paid at that time. So it's not the case that, you can liquidate the portfolio and pay the LPs first, and then the SBA, gets paid at the end. That's not the way the SBA set up the program. So the SBA certainly has rules around that, which you can read as far as how much needs to be repaid when you do a distribution to the LPs on the accrual debentures.
Great, thank you, John. Next question that we have is, do we have a schedule for fees as they relate to the new accrual debenture offering? So there are, I think in the schedule, that slide that we have in parentheses, we said that it only applies to the standard debenture. So there are certain fees that don't apply to the accrual program. So you can take a look at that schedule when you get our slide deck, or again, as we've been mentioning, you can go to the SBA.gov web, and they have for you in some of their guidance that's there. They have a section that will show you exactly what the fee structures are, or is, I should say, for the accrual program. Is the annual charge tied to each commitment? Meaning, I'm sorry, meaning that it won't increase. Sorry, I apologize. The text box jumped when more questions were added, so I need to pull that up. Meaning it won't increase for a commitment that was received in 2024. So the annual fee is tied. So the annual fee is tied to when you actually draw down the leverage. So
That's right.
that fee was what we have on the screen was the fee that the SBA intends to charge going out to about 2029. But that is tied to the drawdown of the leverage.
Right. The actual drawdowns, not the commitments.
Okay, a question. Does the SBA allow you to pay any debenture that you choose? For example, you don't have to do first in, first out.
That's correct. We mentioned that if you pay down, if you draw down a debenture 3 years ago, and that's the one with the highest interest rate, I'd rather go with the highest interest rate, right? You want to reduce the expenses from the fund, so it doesn't matter which one you pick, but generally we pick the ones with the highest interest rates.
I believe we'll have to come back to you on, for example, what's the name or contact for the CFO SBIA group. I'll try to get that and send that information out. So, David, you mentioned that we should pay back leverage as soon as possible. Why?
Well, okay, so you have a fund, you're going through, you're past your investment period 5 years later, and then you develop a wind down plan. And I know I may have spoken too much. You develop a wind down plan. It gets approved by the SBA, this wind down plan, as to your methodology of paying down the debentures. There's a balance here as to what you pay your investors, which if you're an emerging manager in this space for the first time, the words REIT and ROC are going to become very common to you, meaning profits that are available for distribution versus return of capital. And when I say profits available for distribution, there's such a thing as what they call as non-cash. I would caution emerging managers to not always distribute to your investors without making sure you pay back the SBA. For one, you always have to, if you've been approved for 2 tiers of regulatory capital, you always got to make sure you have the 2-to-1 ratio. You could be better than that, but that's the minimum. 2 times of leverageable capital. And also, you want to get the SBA out of the way simply because it reduces costs in the fund. And there's such a thing as surrendering a license and just becoming a regular PE fund. So if you've got the ability to pay the SBA and just do away with it, it's not a bad thing. Simply because there's a lot of regulatory filings that are involved. You file for financing, you file for changes on the capital certificate, you file for distributions, you file for quarterly 468, you got examinations, you've got audits. So it's a lot. It's an expense that the fund could do without. I don't know if I ever spoke too much. That's a lot, but yeah.
Well, something, and again, I have to say that, that's our opinion based on, operating SBIC funds and seeing how they've been operated, I should say, for the last 20+ years. And across, and our life cycle for CSC over 100 SBIC clients. But you also need to pay attention to your operating plan, and really kind of work with what you submitted to the SBA as to how you were going to approach the borrowing of leverage and the payback of leverage. So with everything that we're saying, make sure that you are working within the plan that you have shared with and has been approved by the SBA.
Right, and you can amend the wind down plan, Delphine, but it's got to be approved.
What do you see as some of the biggest challenges, emerging managers face or unaware of as part of this whole leverage draw and repayment process?
John, you want to take it or you want?
Well, we mentioned one with the commitment fees. The process is the process, meaning with the commitment package and the leverage package and actually requesting the draw amount, getting the cash. It's it can be a lot of work, but it's also relatively straightforward. There's really nothing hidden in there. I think kind of a bigger question, or the question I think I would want to answer is, once you have taken, leverage, what are the restrictions that come with the fund? And David alluded to it earlier, that how much you can distribute to your limited partners. The SBA, while you have outstanding leverage, wants to make sure that you're not paying too much back to the LPs before you have paid back the debentures. So he mentioned the concept of REID, retained earnings available for distribution, which we should mention is not the same as retained earnings under GAAP. The SBA has rules about what can be distributed, and I think an example of that would be PIK bonds, payment in kind bonds, where you might be earning 12% interest on a PIK bond, and you would show that as income for GAAP, but for SBA purposes they would not include that PIK income in retained earnings available for distribution. The SBA, it really wants to see cash before it will let you distribute retained earnings there. So that is an example, and we could get into more detail, although I'm not sure that we don't want to do that right now. But it's more kind of what the limitations there are on you after you have taken leverage.
And from my experience, especially for emerging managers, often because I'm focused on the business development side for CSC, emerging managers will say, well, doesn't the leverage draw process pretty much work like a line of credit, where I can go in at any time and draw down from the line? And that is not how leverage works. As we were discussing during today's webinar, it's a process that you have to go through. You can only draw down leverage twice a month. It's typically the first and third Wednesday of the month. You have to submit packages to get it approved. Once you get it approved, you have to submit your debenture notices to the Bank of New York by a certain time frame. And then Bank of New York has to fund that money. So it's not as quick as drawing down from a line of credit. And I think, that's the most frequently asked question that I get is, doesn't it work along the same lines as a line of credit? No, it's a drawn out process. And unfortunately, words matter, so you really do need to understand the difference between your leverageable capital and the regulatory capital and how all the calculations work. I think we
And-
have maybe time for one more. I'm sorry, David, did you have something else to add?
No, and just to add to that, what John was saying, get very close to your analysts, educate yourself in the space, because there's a lot of jargon, there's a lot of other things that you don't deal with in GAAP reporting versus SBA reporting. So attorneys can help. Certain attorneys can help you with the commitment package. In some cases, some of the aspects of the leverage draw request. However, I would say there are very few administrators out there that can handle this kind of that handle this space.
Here's an interesting question. Can you repay debentures and subsequently borrow again?
Yes.
So that was.
That's not the norm, but I've seen it.
Yeah. Okay, we recently submitted a draw request a few days before the 468 was due for the third quarter. The statement of needs began with 2Q 468 in new cash. The analyst asked for the third quarter 468 to be filed before processing the draw request. Is this a new requirement? And if so, what are the specifics? we're smiling.
I laugh at this because, yeah, John, you could go for this one.
The first time we saw this was last quarter. I don't believe we had seen it at the end of Q1 or Q2. It used to be that the 468s were due 30 days. Were due 30 days after. Now they're due 45 days after, and it sounds like the SBA wants to see a 468, that was submitted less than 30 days prior. So during that period from days 31 to 45, we seem to be in a bit of a gray zone there. And yeah, we had a couple of clients that we saw get that message back from the SBA. You need to hurry up and get your Q3 468 in and use that cash balance in the statement of need. So it does seem to be new.
Yeah, and I think we've also seen that historically, even with the 30 days, that especially when you get to the end of the year and you're asking for a leverage draw, let's say in the middle of January, but your 12/31 468 isn't going to be filed until the end of March. The SBA has often asked us to file, I guess you might want to call it an initial form 468 in the system so that they could get a look at where we think the fund was going to be as of 12/31. So we would upload information for that 468. And then as we got closer to the reporting period, finalize all of the valuations, et cetera, then we would go in and amend that form 468. But it's not atypical for the SBA to say, we want to understand kind of where you are within the 468 process. We want to know in October, kind of where you are if you're filing for leverage draw in October and we don't have a September 468 in the system. So they are going to want to kick those tires and get a feel for the fund status. And with that, I do apologize. We will take a look through the other questions. And again, if you email me specific questions, I will try to get you an answer back on those, and I'll coordinate that with my team. We're at the top of the hour. So thank you all for joining. We do appreciate your taking the time to spend this afternoon with us. And everyone, enjoy the rest of your day.
Take care, everyone.
Yeah, thank you. A huge thank you to Delphine, David, and John for this helpful discussion. I saw the questions were pouring in, and as Delphine said, they are very happy and have graciously agreed to respond to any questions that we did not get to after the webinar. I think we have Delphine, we popped your email address into the chat, so you can find Delphine's email address in the chat if you had another question, and we will capture the ones that were submitted and pass those along to the CSC team. Thank you. As Delphine mentioned too, there is an active CFO group here at SBIA. Please reach out to my colleague, Alexandra Arnsberger, for more information about the group. Her email address is africk, that's AFRICK, at sbia.org. We also popped her email address into the chat. You can find it there. And finally, the slide deck has also been shared in the chat as well. And a replay of today's webinar, as well as the slide deck, will be available shortly in the webinar gallery on the SBIA website and also in the SBIA Member Info Hub. Just a few last reminders before we close. SBIA's final regional networking event of 2024 is coming up on December 3rd in Boston, and registration is open for our first 3 regional private equity conferences: the Northeast Private Equity Conference in New York on January 8th and 9th, the Southern Private Equity Conference in Nashville on February 13th and 14th, and the West Coast Capital Summit, also host to our signature LPGP fundraising event, Capital Links, and that is March 25th to the 27th in Los Angeles. Details and registration links for each of these events may be found on our website at sbia.org and in the SBIA membership newsletter. Finally, SBIA is excited to partner with the Independent Sponsor Forum, an initiative designed exclusively by and for independent sponsors and capital providers. The next events in the forum's deal series are on January 30th in Los Angeles and on March 12th in Nashville. These deal-making forums are invitation only to pre-vetted capital providers and independent sponsors. You can visit the Independent Sponsor Forum website at www.isponsorforum.org to learn more and request an invitation to these events. Thank you again for participating in our webinar today, and we look forward to having you join us again soon.